Hello, friends. I'm CMA Punch. Today, let's dive into a topic that I'm sure has confused every single one of us at some point. Have you ever seen a stock just plummet right after the company releases a fantastic earnings report? It makes no sense, right? Well, today, we're going to unravel that mystery. We're going to figure out exactly why markets sometimes fall, even when all the news seems positive.
I mean, seriously, think about it. You've probably been in this exact situation. You've done your research, you feel good about a company, and you're just waiting for that big positive announcement to come out. And then the day arrives and
You see it happen in real time. The company reports record profits, just like you thought. The news is glowing, all the experts on TV are saying it's a must-buy. Everything is pointing straight up. And yet, you pull up the stock chart and it's in the red. It's actually going down. It is one of the most confusing and frustrating things in investing. But believe me, it happens all the time.
okay, this right here is the key that unlocks the entire puzzle. You see, we're all kind of taught to think that good news means the price goes up and bad news means the price goes down. Simple. But the market, well, it's a forward-looking animal. It's not really about the news that just came out. It's about how that news stacks up against what everyone expected to happen. And that one word, expectations, changes the entire game.
So let's put on our detective hats. Our first big clue to solving this mystery is a concept you've probably heard of. The news is already priced in. But what in the world does that actually mean? Let's break it down.
This is the perfect way to visualize how the pros operate. Long before you or I see a headline, the smart money, we're talking the big institutions and funds, they're already doing some deep dive analysis. If they think good news is coming, they start buying, quietly and early. That's step one. All of that early buying action, well, it creates demand and pushes the stock price up. That's step two. So by the time the great news is officially announced to the public, the price has already gone up to reflect it. For the market, hearing the news is like hearing the punchline to a joke they already know. The surprise is gone, and so is the reason for a big price jump. And that leads us perfectly into our second clue, which is all about something called profit booking. This is really where you see the pros make their move.
This comparison is so important to understand. For the smart money, that public announcement of good news isn't a signal to buy more. Oh no. For them, it's the exit sign. They got in early when it was cheap, they rode the price up, and now they're selling to lock in their profits. At the exact same time, tons of retail investors see the positive headlines and think, now's my chance to jump in. So what you have is a flood of new buyers right as the big players are selling their shares. The result? All that selling pressure from the big guys can easily overwhelm the new buyers and the price starts to fall. All right, on to clue number 3. And this takes us right back to that super important word we talked about, expectations. Because sometimes good news just isn't good enough. This chart is the perfect example. Let's say the whole market was hyped up, anticipating a massive 30% profit growth for a company. Then the official results are released and they show 20% growth. Now, let's be totally clear. 20% growth is amazing. In a vacuum, that is fantastic news. But here's the thing. It wasn't the 30% that the market had already priced in. The company actually missed expectations. And in the world of investing, that feeling of disappointment can be powerful. So even with those really strong positive earnings, you'll often see the stock sell off. And that brings us to our final, and maybe the most unpredictable clue of all, market psychology. We have to remember that at the end of the day, the market isn't just a bunch of numbers on a screen. It's a massive reflection of human emotion. And that's exactly what it boils down to. The market is just this giant melting pot of fear, greed, and our tendency to just, overreact. These feelings are incredibly powerful drivers, and in the short term, they can easily overpower any kind of rational analysis of the news. The news is just a data point. It's how we feel about the news that really moves the price. And this can lead to some really weird outcomes. For instance, a stock has been on an absolute tear for months. Then they release some great news. You think that would push it even higher, right? But sometimes it makes investors pause and think, wow, this stock has run up so much, maybe it's gotten too expensive. And that good news becomes the trigger for people to start selling and taking profits, purely out of fear that the stock has peaked. So if there's one single thing to take away from all of this, it's this quote right here. The market is not simply following today's headlines. It's a forward-looking machine that's always trying to guess what's going to happen next. It follows expectations, and it follows the trail of the smart money.
And once you truly understand that core idea, it's a total game changer. You can finally stop having those knee-jerk reactions to every headline and start seeing the big picture. You can start thinking more like a professional who understands the deeper forces that are really moving the market.
I really hope that helped clear things up. If you found this explanation useful, please do me a favor and hit the like button, share this with a friend, and of course, subscribe for more insights just like this one. Thanks for watching.